reversal, kind of given what we saw early on the open. Almost in the opposite of what we saw earlier in the week, where we started off with the markets down, then rallied. Here we did. We came in this morning. S&P was up. I want to say 25, 20. Anywhere from 25 to 30 points on the opening print, and then we get some news come out that maybe shows that the economy isn't ready to open as quickly as we had hoped. And then we're starting to see a little bit of a pullback. So we'll talk about all that. We'll talk about the week that was during what I have now dubbed Rob's Take. So in the notes that we share every day, we call that section Rob's Take. So Rob, you will take it away at that point. But before we get any of that started, let's make sure that we go through our disclosures and then give a little bit more of a detailed agenda if we can. So disclosures for today. Anything that Rob and I talk about is really for informational purposes only, and please do not look at this as investment advice. We want to provide you educational resources and content that we think are helpful for you as an investor and or trader. I think what you'll probably find is our Friday segments that we do are probably a little bit more investor based. I know that is a lot more of the content that you and your team write, Rob, with the Schwab Center for Financial Research. It's definitely more investor type content. I probably, in terms of the stuff that I produce, I'm probably somewhere a little bit in the middle. Some trader content from my background as an options market maker, but also some investor content because, to be 100% honest with you, Rob, I just find it more interesting. I find it more interesting to study the macro world, what's going on that 30,000 foot view. And that's kind of how, from day one, we've structured this show, this closing remarks, is really start off with that kind of 30,000 foot view and then kind of whittle our way into the markets and then sectors and then, stocks to watch. And that's kind of how we've done it. And I hope that you guys like the format and as we continue to move along with that. All right, agenda for the day. Just mentioned, we'll do a little bit of a market recap. I'll kick it off with a little bit of technical analysis. We'll start taking a look at the indexes, even a little bit of sector analysis. I'll talk about the winners and the losers of the week, what we're seeing so far. We'll get into some of the broad market headlines, and then we'll head into Rob's take on the week that was from an economic standpoint. Some of the data points that came out we should be paying attention to. And then we'll finish it off with maybe some stocks to watch, some stocks that are in the news. And then, as always, make sure you guys get your questions in. We love to see your questions. We love your engagement. Gives us an opportunity to connect with you and make sure that we're providing you the data points, the news that you need. All right, let's kick it off with a little bit of look at the S&P. So, Rob, it literally was last Friday. Mm-hmm. When you and I were sitting here talking about this candle right here, it was this one. Right. It was that move where we had kind of broken through this, rising wedge, rising triangle, if you will, and it had kind of headed below. And you and I were looking at that, and we said, hey, this could portend, potentially some downward moves in the market. And I'll tell you what, for over the weekend, we looked like geniuses. And then sure enough, Monday morning came out. S&P futures were down 80 points. And then old Chairman Powell stepped to the mic between Tuesday and Wednesday and really kind of moved things around when not only he, but also the White House, started to outline some more, stimulus plans that could be put into effect should the market call for it. And we started to get that bounce back. You can really see that movement right here. Nice little candle. This is where we opened around 29. Where you opened around 29.90, traded down around 29.60, and then by the end of the day, we were up basically almost 100 points, or really 100 points off those lows. So really nice intraday turnaround. You can see Tuesdays was kind of an inside day, right? You opened here, you traded up, you traded down, held that 20-day moving average, and pretty much right back to where we were. Wednesday, not a lot of movement. Yesterday, not a lot of movement, kind of sold off in the morning, but then rallied into the close. And then today, it looked like it was going to be one of those mornings where we start pushing back up. It looked like the markets were going to try to overtake that 3150 level. Had been a little bit of resistance recently. Maybe try to fill in this gap a little bit. And sure enough, as the day progressed, as news came out, as it seemed more and more like, maybe with the spread of some of these COVID cases, maybe this whole idea that the economy is going to be back up and running fairly quickly, maybe we got a little bit ahead of ourselves. And it got to the point where even Boston Fed President Rosengren came out today. Now, we do need to mention he is a non-FOMC voter. He thinks that an economic rebound in the second half of the year will likely be slower than initially expected due to continued spread of the coronavirus. Rob, you and I talked last week that that was the same type of language that was coming out of the IMF, where they said they're revising downwards their International Monetary Fund, excuse me. They're revising downwards even their prognostications just from April, and they're kind of taking it down a bit in terms of how quickly the world economy starts to rebound from where we've been. So to see that happen internationally, and now to kind of come back domestically and see our own Boston Fed President Rosengren speak to that, it provided a little bit of a pause in the market, and then here we are, off the highs of the day. The high today, it looks like we traded up to around 3140. We're not that far off it, and we're holding that 3100 level, and it looks like going into the close, at least we're holding the 20 here. The 20-day moving average is at 3090. We still got the RSI up above 50. Okay, so that's still bullish. Anytime you're up above this 50 level when we're holding, as we really have basically since the first week of April, we've held this 50 level. As long as we can continue to hold that, you got to make the assumption that the trend will continue. However, we are starting to see a little bit of cracks here, some fissures, if you will, where the momentum just seems to be slowing down. And Rob, yesterday I had Tony Zhang on, and he and I were talking about the fact that it doesn't mean that the bull run's over by any means, but it does mean that there could be some consolidation. And what are your takes? What are your thoughts on consolidating at this level? Does it seem like that's kind of the direction the market is headed, or are you saying, hey Joe, no, we're going to bounce off this and head back to new highs? What do you think?
No, I think it's more than reasonable to expect some pause or consolidation here, given the sharp rally we've seen. 4 of the last 5 weeks, we've seen pretty decent sized upward moves. So I wouldn't be at all surprised, especially with we got the overhang of the headlines in terms of new cases being reported, not only here but in China as well, and they've reinstated some of their measures to lock down certain regions there too. And then you look at the overall economic backdrop. I know some of the figures that we'll talk about that came out this week, they're pretty astonishing from a percentage point movement, but you look at the levels they're at, it kind of makes sense that the markets may be a little bit ahead of themselves or gotten a little bit ahead of themselves.
Yeah, no, absolutely. I mean, Liz Ann talks in her article talks about warp speed, right? I mean, warp speed on the way down will lead to warp speed on the way up. So anytime you're getting a bounce off some pretty awful numbers, I mean, they look gaudy in terms of the response. But at the same time, you're starting at such a lower level. Remember, you get a 50% retracement. It takes 100% to get back to break even. So we got to kind of put these numbers into context a little bit in terms of what we're seeing. All right, quick look at the S&P. It looks like 3,100 is the level that it is sitting at right now. Like I said, right at that 20-day moving average. There was a question in terms of some of the technicals. So last week we looked at the weekly chart. And we were talking about the idea that going into the close, remember this, Rob? We were looking at potential for an engulfing pattern on the weekly charts, where you had last week at this time, I mean, literally this exact same time, we were having this conversation where it looked like it was going to be engulfing. It looked like it was going to be a very bearish candle that could set off a potentially lower week this week. And going into the close, what they do, they push it up. And so we did not see that bearish engulfing. It did not hold. So didn't want to answer that question because that had come up, said, hey, Joe, can you revisit what the weekly candles look like? So last week we did push up above right before that close, right? A couple minutes before the close. So we did not have a weekly bearish engulfing. You can see here, we did open below the low of last week, or excuse me, we opened right around the low of last week. Traded below is a better way to put it, below the low of last week, and then here we are, kind of smack dab in the middle, pretty much. So not a lot to garner out of that, but by looking at the daily charts, I think there's a little bit more that we can look at here. You know, there was a comment around an island reversal potentially from here to where we're at right now. You could definitely make that case. You could definitely make a case that there's a potential for an island reversal forming right now. And what I'd really be kind of keeping an eye on is if we do break below this 20-day, does this 200-day hold? Because we did trade below, we settled below the 200-day. I mean, really just a skosh below, if you will, last week. And then within 2 days, we rallied up above and held it. So I would keep an eye on this level down here. I think that's fairly important. And even more so would really be around this 29.50 level. Because watch what happens when I draw a little bit of horizontal support in here. Look what happens here. I'll make this so it's easier to see. What we're going to do is you'll see the alignment here with this horizontal line. It encompasses these two failed rally attempts and then the breakout, and then here's exactly where we sold off to, held that level basically right at that level before rallying back. So keep an eye on this one. It's around 29.50, 29.60, give or take a few points. But remember, Rob, when we're talking $2,900, 11 or 12 points on a $2,900 product is not the end all. And I do want to make that point. I think a lot of times we get so caught up in whether it's settled 1 or 2 points below, but at the same time, we're looking at a range. So I hope that makes sense to everybody. All right, Rob, let's take a look at the Dow Jones. Now, let me ask you this, Rob. When you're analyzing markets, and I know you're not as much of a technician as say Lee and Kevin Horner and some of the other people that that are on Schwab Live Daily, but do you tend to look more at the S&P or more at the Dow for some indicators?
I look at the S&P 500. It's a broader base, and it's different weights. In terms, it's not a price weighted measure as well, like Dow is, that can be skewed by 1 or 2 components of the index. So yeah, for a broader view of the corporate sector there, I tend to look at the S&P 500 and put more weight into that.
Yeah, I think that makes a lot of sense, especially, and the reason I bring that up is because this is one of the 2 of the indexes right now that's actually below the 200 moving day. So you got this, and then the Russell, which we'll get to momentarily. But here we are below the 200. But really, what you're playing or what you're looking at when you're looking at the Dow Jones at this point is really going to a certain extent, and that's what you mentioned, this idea of it being a price weighted index. The problem with the Dow is looking at that, and I don't know why it still gets the press that it does, but the problem is when you're looking at something like that, you're really looking at the higher price stocks and the weight that they have. Your UNHs, your Boeings at this point, Apple's at this point as well too. So you can see as Apple's kind of reversed fortune intraday, what that did to the Dow as well too, just because of the fact that they are the price that they're trading at. And it is an index that's price weighted, whereas the S&P is market cap weighted. So Apple's basically the largest component of the S&P, but because its market cap is the largest as well too. So it's a little bit more indicative, and I think it probably makes more sense to look at the S&P as well. But while we're talking about the Dow, let's move a little bit into maybe a little bit more sector specific. Talk about the transports. I find it very interesting that the transports have held up as well as they have, because I have not really seen, we have seen some indication that bookings going forward, you've seen this from some of the airlines come out and show a little bit of positivity on the bookings front going forward. You're seeing a little bit more movement in the rails and so on and so forth, but boy, it sure does seem like we've had a quick run off the bottom from the transports here. This is one of those areas right now where I am potentially seeing some weakness, and it's something I really want to keep an eye on, because I think as the transports go, you're really going to see that kind of weighing into what we see on some of the indexes. Because I mean, the bottom line is, Rob, the transports represent how goods get moved to and from the country. And if we're getting news coming out of the rails, we're getting news coming out of the airlines that, while it is not as bleak and while it's pointing a little bit of a rosier picture, if once we start to get earnings come out within the next month or so, if we start to see from them that well, some of the anticipation for the reopenings has not matriculated into movements of goods and services and movements of people when we're talking about airlines and cruise lines and so on and so forth. This to me seems like one of those areas where it could be really susceptible to a pullback. What are your thoughts on that?
Yeah, I totally agree. I mean, I would like to see, the rails and like you'd mentioned, the transports that move goods and services or goods around that see them, kind of getting some momentum there. That'd be a good sign. And then, like you'd mentioned too, the index is also weighed down by the airline sector there and the cruise lines that have been severely impacted by the pandemic there. And also, I mean, even with the relatively rosier comments regarding capacity and bookings and all that, it's still a long road ahead that to get back to maybe pre-crisis levels and maybe a few more years. So those are two things. I mean, I would want to pay more attention to how the transports and the rails are doing, just to kind of get an indication if the reopenings are starting to gain ground and gain some traction there, to see some activity ramp up there. And we heard from Union Pacific CEO this week too, and he was optimistic but still very cautious about volume levels and being very depressed still, and still got some ways to go to get back to normal.
Absolutely. So a good question just came in. They're all good questions, but this one I'm going to point out in particular says, Joe, I've always found it strange, that most all the stocks go down when a story on maybe one stock can influence the entire market. How is that possible? Well, the reference to Chicken Little, I don't know about that, but I will say this: when that one stock, is part of the weight that it holds the weight that it does now in the S&P, when that one stock has a negative announcement like, hey, we're going to be closing down 11 stores that it just recently reopened a few weeks ago in Arizona, Florida, North Carolina, and South Carolina, you got to remember there's 5 stocks now, 5 that make up over 23% of the market cap of the S&P. So between 5 names, and this being one of them, when you're seeing, selling pressure within those names, it's going to have an outsized effect because of a couple things that are happening, right? Because these names are making up are a large proportion of an index. So an ETF that trades off one of those indexes, being the spiders, what they're going to have to do is they're going to have to adjust in real time, the weight of the holdings within the spiders to match what's happening in the S&P. So if Apple's pulling back, well, the spiders are going to have to pull back as well too, and that's going to affect all of those names within that ETF. So that's a great question, and because I think it kind of goes to the idea that how does one name have that much of an effect on what the market's doing as a whole? When we looked back and we saw, at one point we were up around 3,200 in the S&P today. So how is it that we had this big move back? Well, the bottom line is because you had the biggest component of the S&P come out with some negative news, and as that started to move down, you started to see the market pull back as well. So great.
And Joe, I can add to that too. It's what news they reported as well. It's not like they came out and said they're closing stores because the demand's not there or any kind of micro perspective there. It's one of the biggest headline risks out there, and it's the an abundance of caution they mentioned, but it's due to the rising cases of the coronavirus. So that's a big news piece for the entire markets, because we've seen it be whipsawed around by any kind of headline in regard to that.
Well, and a lot of the upward momentum that we saw was contingent upon the idea that we're moving along in terms of reopening the economy, right? So, once that news starts to dissipate a little bit, and you see anything in contrary to that, then yeah, it's going to have a negative effect. I absolutely agree with that. A couple more real quick. We'll answer some more of your questions along the way, and then I'll let Rob take over here. The Russell, this is the other one I mentioned that was below the 200-day. And so a quick question comes in from Linda. She said, hey, what's more important, Joe, the fact that they're holding the 20-day moving average, or that the downtrend from the line 2 weeks ago? Okay, that's a great question. So basically what Linda is saying is if you look at the short term here in the Russell, even back to the S&P that we were looking at before. Not necessarily that it's holding the 20. She's saying, hey, shouldn't you be looking at the fact that, we failed at an attempt to a new high, and then we're having a lower high this week than what we even saw last week, going all the way back to March. I think it's a great point. But, and I think that, what you want to do is you want to look at this and say that maybe this upward bullish trend is losing steam. And the way that I measure that is partly by this RSI here. You can start to see the RSI is rolling back over too. So as you saw us kind of, moving towards new highs, or not new highs, but at least newer interim highs here, what did you see? You saw us moving up, but then you really saw the momentum start to come out last week, right after Chairman Powell, his testimony on Wednesday. And then even as we started to come back up a little bit, we were really starting to see kind of this RSI roll over. So absolutely, I think that's a great point, Karen, and I think that's something that you should all be watching right now, is not just the fact that, we're holding the 20, but keep an eye on this RSI. Because if we start to give this up too, and then we start breaking below 50 on some of these RSI levels, it's telling me that, this bounce off the low is really starting to lose some momentum and some steam. And it doesn't mean that it's turning into a bearish chart, but what it means is that what was once bullish could be sideways for a while. We could be in for some consolidation. And these are the levels, I mentioned earlier, in the S&P, I was talking about that 2950 level is an area that I, between 2950 and 2970, this area right here, this is an area I want you to kind of keep an eye on. And if we go back to, let's say, the Russell, I would absolutely be looking, in this area that we held right around 1350 back here. There's an area we had a hard time getting above for a couple instances before finally popping up above. And you do remember, we did have a couple weeks where the Russell was the big outperformer, right? Real big outperformer. It's something that, Liz Ann mentions in her article about the zombies versus the non-zombies. And in the Russell, where you're seeing a lot of these zombie type companies in the small caps that were outperforming, and people were just kind of scooping them up. The likelihood of that continuing in the long run is pretty slim, to continue to see companies that can't use revenues to finance their own debt. So she's saying use that as a little bit of caution when you're looking at what's happening in the small caps. And what I'm saying is absolutely look at that, and then also kind of look at any rollover that we're seeing here on the charts. If you're seeing us start to fail some of these moving averages, and you're starting to see some rollover in the relative strength of the RSI, that's something you want to be keeping an eye on as well. Okay. Now that we've done that, Rob, I'm going to turn it over to you, and I want you to tell us what we should be keeping an eye on from the macro level, or at least from the week that was.
Okay, yeah, thanks, Joe. Yeah, it's just setting up where we came from last week. We had talked about the disappointing market action towards the end of the week there. Kind of gave us a little bit of a bad taste in our mouth going into the weekend. And then as the markets opened up on Monday, they, kind of followed through a little bit on that. But, one thing that came out, and one of the biggest drivers of this big march off the March lows, the big rally off the March lows, has been the flood of stimulus from the monetary and fiscal policy side. And we had a couple of stories that helped markets kind of reverse. We saw the Fed announce that they were going to start beginning to purchase individual corporate bonds this week, and then also kind of some reports that the White House was mulling another $1 trillion infrastructure spending program too. So that kind of helped the markets on Monday reverse. So we had some pretty good regional manufacturing activity out in New York region. That's a key region there for activity there. It came out, it increased way more than expected, but did remain slightly in contraction territory there. So we kind of got off to a good start on Monday there. And then we continued to get, support from, I've been seeing like three pillars that we've been getting support from. I mentioned the massive flood of monetary and fiscal policy stimulus measures there. Then we got, the optimism of some of the economic data that has been coming out, and I'll hit on some of that this week. We saw Tuesday we had a retail sales report for May was, pretty astonishing percentage gain there as a record monthly gain. But remember, like we talked about earlier, it's remember where it came from is where we, that when you take a look and try to digest what that means. But that kind of gave some optimism to the markets there and continued that run there. And then we had home builder sentiment. The housing market has been really on fire right now. We've had some pretty good data points for the last few weeks. I mean, mortgage application activity with purchases have been up for 9 straight weeks there. We had home builder sentiment unexpectedly jump right into back into the demarcation point that separates good and poor conditions. So it jumped back into good conditions. And then we had the index leading economic indicators is also a stronger than expected recovery there. Now, albeit it was due mainly to the moderation in jobless claims that we've seen the past several weeks. It's the rate of increases of new employment claims have been decelerating, but still remain painfully high. So keep that in mind there as well. And then one regional manufacturing report I saw there out of Philadelphia, that was a major surprise to me. It jumped really far into expansion territory for June. That was a June reading there. So kind of got underpinned. That was one of the pillars adding to the monetary fiscal stimulus. We had some economic data kind of come out and continue that theme we've seen in the past few weeks, that maybe, hey, we're getting some momentum on the economic reopenings, and the data supported that. But I did mention jobless claims also came out this week and still remained, continuing claims remain stubbornly above the 20 million mark. So that's definitely a figure that's going to be a key data point going forward that we're looking at to see when that starts to moderate, because the key to this is going to be chewing through that, get that high unemployment level, and getting people back to work and getting the economy back to relative normalcy. So we'll keep an eye on that. And then we had continued with the Chairman Powell did his semi-annual 2-day congressional monetary policy testimony, where he reiterated the pledge that they're going to do pretty much anything and everything necessary for as long as necessary, and maybe even a little longer than might be required, just to make sure that the economy's back to getting
or suggested
targets. Yeah. So and then we had the third layer, and this was been a theme there with the COVID-19 pandemic there, the progress on the healthcare front in terms of trying to find an answer to the virus there. And we had a report out this week that seemed to catch even some of the bigger health experts by surprise there, a low dose steroid treatment that came out, and it helped, a study showed it helped save lives in patients who were seriously ill. So that those three sources of bullishness kind of helped the markets rebound, and now we're up 4 out of the last 5 weeks, and and heading into the weekend here, I know we got a little bit of a pullback going. It looks like the Nasdaq maybe moving back into positive territory, but yeah, it's the markets continue to hang on to those three things: the stimulus, the economic data that continues to, and also some commentary from the earnings or the corporate sector too, is showing signs that trends, at least business trends, in late May and early June are starting to improve there. So the markets posted another strong week there, and overshadowed what we had, these new cases. That's we saw some of it today, late today and this afternoon here, that the new cases maybe fostering some concerns about that second wave maybe being a potential. But for right now, those three pillars are kind of supporting the markets right now, and that's what we saw this week.
So the question came out from our audience here, and I think it's a good one. And you and I have talked about it before, but now Jeremy Grantham is commenting on it on CNBC earlier today, talking about the bubble, and basically he said that this is the fourth of I'm trying to think, the fourth, he used their term, real McCoy bubble of his career, and he he was the renowned investor who basically called a few of them in the past, right? 89
Mhm.
in Japan in terms of their real estate bubble and market bubble, the tech bubble in 2000, and then using or the U.S. housing bubble in 2008. So people pay attention when he speaks. Um, so you and I have addressed kind of our thoughts on valuations. Even if, like I said, even if you put some of the higher forecasts for 2021 earnings, you might put the S&P around anywhere between 135 to 140 in terms of earnings. And at 130, we'll say 135 because 140 is pretty high level from what I've seen. But even if that's the case, right? And we're looking at the current market, excuse me, at 3,100, give or take. We're still looking at, say, a 23 forward PE on the S&P 500, so a very lofty level. And it's interesting that I don't want to say we're putting our blinders on, but it's interesting that to a certain extent we are kind of looking past that. And I had this conversation yesterday with Tony Zhang, and he said, Joe, the other thing you need to remember though is that the Fed is providing that backstop, right? That's basically 0% interest rates through 2022. And when you're looking for yield, this is where you have to go to a certain extent because there's no other game in town. And that is, to me, that's a scary backdrop for any market is, you invest because there's no other game in town. But, to a certain extent, it does, we can't just look at old PE multiples, I guess is what I'm saying is we can't just look at old PE multiples as the end all for determining whether or not, market valuations make sense. There's other ways to look at it. When you factor in, um, when you factor in a discount rate and a multiple, and you're looking at basically zero in terms of interest rates, well, it's not as lofty as you think. But then when there's other things you look at, when you look at market cap to GDP, I mean, it is through the roof expensive. So it's just hard to find one one way to pinpoint a market valuation. What are some of the things that you and your team look at when you're making some of your sector calls and you're making some of your market calls?
Well, yeah, I mean, valuation right now, especially in this environment, when we got the E portion of the PE ratio is still highly uncertain. So the analysts are flying blind right now still, and Liz Ann always points out too that valuation is a kind of a terrible market timing tool in any environment. And it's much as a sentiment gauge as it is a fundamental gauge too. So keep that in mind. But yeah, we look at different factors in terms of fundamentals, the macroeconomic environment, momentum. We do use valuation, but right now that's we've kind of had to go back to the drawing board and kind of retool some of our sector analysis there because we still have that big uncertainty regarding the where earnings are going to be, and that's what brings next month's going to be a pretty pivotal year or month for the markets in terms of trying to gain some clarity because we've got the start of Q2 earnings season will ramp up. We'll get some commentary, not necessarily the results from the second quarter, but what second half commentary is from the companies there. That's going to be a pretty good driver of trying to find some of this clarity on the earnings there. And then we're going to have the first read of second quarter GDP as well. And we've seen a huge range of forecasts for how deep the contraction is. So next month's going to be a pretty big month to kind of help determine some of the earnings and what we can forecast going forward.
Yeah. No, it's interesting. Now, I brought up here performance by sectors over the past 5 days, and so I like to look at the 5 day and 20 day because basically it relates to a 1 week and 1 month, and you see, over the last week, healthcare, IT, communication services, those are the leaders, and you like to see momentum in those names. You'd rather see the movement occurring in there than you would say in utilities and staples, right? It shows that the risk on trade to a certain extent is back. But what's interesting is, you could make a case, especially given valuations, that people are actually hiding out in names like Apple and Amazon and some of the FANG names. And it's a conversation I never thought I'd ever have. But when I've heard the commentary on it so many times that, well, people are hiding out in those names because they seem like safe picks. And I'm like, wow, that's pretty interesting to think that
Yeah.
that information technology and communication services and these names that we, at one point we thought were high flyers now is an area where you're starting to see some investors hide out in. So, it's a different market. It's not your typical fundamental type of looking for value pickers type of market. But I mean, it's kind of hard to argue the results. I will say this, and here's my question to you. Are you guys starting to look at maybe some different sector rotation calls, kind of given the movement that we've seen recently?
Absolutely, and that's we just updated our sector views yesterday, and we made some pretty not big changes, but some a lot of changes in terms of our looks and our ratings on different sectors, and I'll go over a few of the highlights there. Liz Ann has talked about this too. The markets have had kind of a three-stage since the February highs, a three-stage kind of runs. We've had the bear market from the mid-February high to the March lows. That was the bear market. Then we had the recovery from the March lows to mid-May. And then we have right now what we're seeing is kind of a cyclical phase shift right now. And, given that backdrop there, we've kind of adjusted our sector views there. We no longer are outperform rating on the healthcare sector. We believe that the fundamentals and some of the positives are still there, but there's still some uncertainty going forward in terms of the healthcare equipment and services group, given that they face some significant headwinds due to the near shutdown of elective care and elective surgery, elective services there, and so that could be a drawdown there. Also, with a shift that we're seeing towards maybe a cyclical phase here, that that we don't see the healthcare sector outperforming, but we did move the financials from an outperform to an up, or from a market perform to an outperform rating, and you can see there on that chart we have those factors: macroeconomic, valuation, and relative strength, all flashing green there. We think the recent uptick in long-term yields. Remember they make their money by borrowing on the short end and lending on the long end, and we see not a huge move up in the long end of the yield curve, but we do see some momentum gain there, and we could see some continued steepening of the yield curve, and that will help the sector as well. And then after, in the wake of the global financial crisis in 08 and 09, the regulators really made sure that the banking sector had the balance sheets to weather another crisis like that. So they came into this pretty well stable and pretty healthy on terms of the balance sheet there. So we think that could help out the sector as well. And then we hear all the last earnings season, the financials kicked it off and they boosted their loan loss reserves, and that was a pretty big shock. It kind of moved the markets there, but we believe that some of the I mentioned before, the fiscal and monetary policy support's going to help try to mitigate some of that impact there on delinquencies, along with the consumers. You can see the data. If you looked at last month's personal income and spending data, you saw the savings rate jumped up to about 30%. So that helps the consumer side kind of weather some of the storm, and may make it to where those keep in mind the loan loss provisions aren't the same as taking a charge or actually booking the loss. It's just preparing for the potential for it. So we feel that some of the policies are out there, the health of the consumer's balance sheets heading into it, that may help mitigate some of the delinquencies and the risk of the bad loans. So we feel that the financials may be ready to outperform the market. So we boosted that up a little bit for the market perform to outperform, while downgrading the healthcare to market perform. We didn't downgrade it to an underperform, but we just moved it down a little bit to a market perform. And then upgraded to, given the cyclical shift we may be seeing here, the material sector up to a market perform from a underperform there. So we feel that improved prospects for the global economic growth has helped out. The one thing we noticed in the material sector, and they're tied to movements in the U.S. dollar, and we've seen recently the U.S. dollar kind of soften a little bit, and that would definitely help out some of the materials that are priced in U.S. dollars. But the reason we didn't go to a full outperform on the materials is they still faces some challenges because global growth is not expected to provide any enduring tailwind, and the demand for chemicals, which is the largest industry in the sector, is still being hampered there. So we kind of tempered our outlook there, but still have a little bit better forecast for it moving forward. And then we moved the utilities to an underperform from a market perform. We feel that like I mentioned, our view that we may be seeing a cyclical shift, maybe tends to historically not favor the utilities there, which is a defensively natured sector there. And then also, even if the market did turn down, we saw even before the crisis there, the search for yield that had gone on the previous year and a half, 2 years has boosted that sector, and it may not fall back on their traditional defensive performance going forward, even if the market does start to roll over there. So that's
Rob, that's a very politically correct saying. It's not cheap. So there you go. I like that. I like that. You've learned very well. Congratulations. No, all this makes sense. I guess just like the market in and of itself, a lot of these can probably. You guys aren't willing to turn on a dime because this is more investor type recommendations as opposed to trading type recommendations. So I get that 100%. And I think we also need to be aware of the caveat that even materials is a great example. I mean, if we start to see a bottoming out in the market, or in demand, and you really start to see the demand ramp up, well, you're going to see big outperformance in the materials, especially if the dollar remains or softens further. You would see that. You would see that in materials. You see it in energy. I mean, you've seen what's happened in crude recently, as we put a bit of a bottom in here. Let's bring this up. Let's take a look at the crude chart here. There was interesting news coming out of the U.S. today, and that rig counts are the lowest they've been in 11 years. And so, I mean, a lot of times we get fixated on charts and support lines and RSI, but I mean, good old-fashioned fundamental analysis tells you that, hey, when I'm seeing a rig count the lowest that it's been in 11 years, well, that means that output's going to be slowing down dramatically. And if output slows down dramatically, now we're in an environment now where hopefully that supply slows down enough and demand starts to catch up, and you start to see crude prices, start to catch a bid, and that's what they've done. I mean, this whole run from the bottom here, and this doesn't even take into account the negative print. I don't even bring the Junes up here because it doesn't make sense. But July, we did trade down to 17.5 before getting back to where we're at. So we put in more than a double off those lows. We pulled back a little bit at the beginning of the week, and here we are trading back up. So the combination of lowest rig counts that we've seen in 11 years, and the combination of basically a worldwide OPEC plus, if you will, commitment to slowing down supply has kind of helped put in a little bit of a bottom for oil, and we see that moving forward. So, I mean, look, Rob, we can look at all the economic data as it comes out, but I think the bottom line is really this: we just kind of, if nothing else, we really need to see a bit of a slowdown in the cases, because unless we see that, we're going to see what we saw today with Apple shuttering some of its stores and saying that, hey, we can survive online for a little bit longer. So we're more interested in the health of our employees and keeping them safe, and so we're going to be shutting down some stores, and so that's not good for the economy. But I will say this: that does kind of bring back the stay-at-home trade. So when you look at some of the names that have just continued to do well, I'm not saying you have to stay on the stay-at-home trade train forever, but when you get flashes of news like this, keep an eye on what is happening to these names, because when you see, your Zoom medias, when you see your DocuSigns, and you hear news about more and more potentials for outbreaks occurring, look what happens. I mean, look at the relationship between that negative news coming out on the economy and negative news coming out on the COVID-19 outbreaks, and what's happening with some of these, the stay-at-home stocks. And not, not a recommendation, but I'm just saying, keep an eye on the relationship between the two, because it might make a little bit of sense to at least, be aware of that relationship and how those stocks are performing when you do get that negative news. All right, guys, you had great questions today. I appreciate, as always, you tuning in. I appreciate, as always, Rob, you and your insights. Rob, I hope you have a wonderful Father's Day this weekend.
Hey, happy Father's Day to you too, Joe.
All right, happy Father's Day to all of the fathers out there. I hope what that means is that you enjoy your barbecues and your pools, and just enjoy being a father, because I know that that's a special gift that I have. And looking at my 8-year-old boy right now, who's writing me something, asking me if he can play on Madden while I'm doing my broadcast. Okay. We'll get to that one in a minute, son. But to all of you, to all the fathers out there, I wish you a very happy Father's Day. And I hope you all have a wonderful weekend. We will be back on Monday, first thing Monday morning, 10 a.m. Eastern, 7 Pacific, with Trader Talks. Look forward to seeing you for that. To quote my buddy Tim Capella, I still believe in the merits of this economy and the market. And I hope you guys all have a wonderful, wonderful weekend. Thank you. Bye-bye.
Hi, this is Jeff Kleintop with 90 seconds on what we're watching that could move the markets this week. It's been an impressive run for stocks, but last Thursday they took a breather with a 6% drop, taking stocks back to where they were about 2 weeks ago. Now, the sell-off took place after markets became more vulnerable by pricing in a V-shaped economic recovery in recent weeks, evidenced in the strong gains that were accompanied by a rotation to economically sensitive stocks and the rise in bond yields. Now, triggers for the sell-off seem to be the risk to the economic recovery posed by a second virus wave and the outlook for a slow labor market recovery from the Fed, which was reinforced by Thursday morning's weekly number of new filings for unemployment benefits, which remain well over 1 million. This week, Fed Chair Powell testifies before the Senate on Tuesday and the House on Wednesday, and could echo his gloomy tone from last week. Also, a stubbornly high jobless number this week could also be disappointing if it suggests the labor market rebound in May is now losing steam. However, much of the data this week probably continue to point to a solid recovery. Now, the Bank of Japan, the Bank of England, and the Swiss National Bank set monetary policy this week. Also, European leaders may meet to discuss a €750 billion recovery fund proposed by the European Commission. And the market may welcome more stimulus. Already, the total global stimulus is equivalent to a jaw-dropping 28% of world GDP. Thanks for watching.
At any point in time, stock prices are trending upward, trending downward, or trading in a range. And really, that's it. As a trader, it may be useful to know which of these scenarios you're seeing. Technical analysis uses charts to track price and volume ranges over various time frames in an effort to gauge which way the stock may move. Identifying these trends and price action can help you decide when to enter a new trade or exit an existing position. For the technician, price is king. Technical analysis can help you take the emotion out of trading because it assumes that all of the news, the earnings potential, and consumer sentiment are already baked into the existing price. This means that you trade based on what you see happening, not what you believe should be happening. Because psychological factors can also drive markets and are often predictable, technical analysis uses charts to offer a picture of how markets act when a stock reaches certain price levels. By watching for changes in price action and trading volume, you can gain insight into what other traders are doing, and that can help you make better decisions with your trades. So let's look at an example. If a stock has a history of retreating to $50 per share and moving higher from there, you could enter your trade near the supporting price of $50 and look to sell once it moves higher. Keep in mind, you shouldn't rely on past performance to assure success no matter which indicator you're following. In this example, you would want to set your stop order just below this $50 level to help limit losses in case the stock were to reverse and fall through our support level. Falling through this $50 level of support would be a clear departure from what the stock had been doing. It can indicate a shift in sentiment, meaning many traders might have lost interest in this stock. And once that happens, the price could continue lower to its next level of support, making your stop order very important. And remember that there's no guarantee that your stop order will be filled at or even near your stop price, because once it triggers, you're entering a market order. Keep in mind that technical analysis is not a guarantee of success. It works best when you use a combination of tools and indicators to get a full picture of what the market is doing.